Welcome again to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss our 4 key points, highlighting key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll review some historical pullback data and share with you why you should stay the course. In point number 3, we'll discuss why you've likely seen headlines of a recession on your newsfeed. And lastly, point number 4, we'll talk through the volatility index. Now, over the past month or so, the market has rotated from large cap technology stocks to small caps in other sectors. Current macroeconomic conditions, specifically inflation returning to 2%, low but rising unemployment, falling interest rates, and the stock market gains are exactly what we had hoped for at the start of this year. Now, I believe what we've experienced over the past couple of weeks is a transition from market normalization, which I specifically mean the post-pandemic market normalization, to actual normalization. And we'll explore this in more detail throughout this video. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. The Atlanta GDP Now forecast projects a healthy 2.9% growth as of August 8th. This is up from the 2.5% reported last week. Next, each week, we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. Initial claims for unemployment fell by 6.8%, or 17,000 claims, to 233,000, while continuing claims for unemployment also fell, however minimally, to 1.875 million, an adjustment of 2,000 occurred. The decrease in initial claims was a breath of fresh air for the market after last week's unemployment rate of 4.3% was found. This metric provided economists and investors the confidence they needed to stay on course with the belief that the Feds will cut rates soon. Next, for 2024, we are watching mortgage rates very closely to see how home affordability is trending. This week's rates fell with a 30-year and 15-year ending at 6.47% and 5.63% respectively. Another relief for investors and those in the market for a new home. This is the lowest we've seen either the 15-year or the 30-year since Q1 of 2023. Next, let's talk about investor sentiment. One component of investor sentiment is the measurement of the bull to bear spread. The latest update shows the bull to bear spread falling from 19.68 last week to 3.09. Investors are only slightly bullish with the current market. Next, we will continue to update you all on the Fed rate cut probabilities based on future contracts, specifically watching for the September and future FOMC meetings. Currently, the CME Fed Watch tool has a coin flips chance that there will be a 0.25% or 0.5% decrease in September. Based on our research, I estimate that we'll see multiple rate cuts this year and may even reach the high 3s or low 4s by the end of this year. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 3.06%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 2.07%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was positive 3.55%. So, international stocks taking the win this week again, that's 2 in a row. Some may call that a win streak. Remember, we watch these markets and sector fluctuations weekly to show you in real time or near real time the importance of diversification. Volatility in one market may not correlate with others. On to point number 2, the stock market pullback. Investing is never a sure thing. In the classic book, A Random Walk Down Wall Street, the author writes that the stock market is like a gambling casino where the odds are rigged in the favor of the players. Investing in the stock market comes with many risks, and that can be managed with proper portfolio construction and a long time horizon. History shows that despite the ups and downs of the market, staying invested is still the best way to grow wealth and achieve financial goals over the course of decades. Stocks never move up in a straight line. So how we react to market volatility is perhaps more important than volatility itself. The S&P 500 has now experienced its second 5% or worse pullback this year. As the chart shows, this is below the average of 4 to 5 pullbacks experienced in the average year, and dozens during a bear market. Additionally, current market concerns driven by tech stocks, the Fed, and the labor market have their silver linings. The economy is still quite healthy, corporate earnings are still growing, and if interest rates do sustainably fall, many other parts of the market could benefit. As in past episodes of volatility, seeing past the current market moves and the headlines is needed to benefit from the long-term trend. Investors focused on recent performance alone would no doubt wonder if the cycle is over. While recent market events are still playing out, it's important to remember that not only are stock market swings normal, but they can also be healthy if they are a result of investors adjusting to new economic facts. This is especially true if valuations improve as, as prices adjust and corporate earnings continue to grow. For many investors, the volatility since 2020 may have already seemed like a distant memory after the steady recovery in the past year and a half. As the chart on your screen shows, the S&P 500 has gained 113% over the past 5 years, and this includes the pandemic collapse as well as the 2022 bear market. While market pullbacks are never pleasant, viewing the market in these timescales helps to put the current decline in perspective. So the bottom line, recent economic data have sparked recent economic data have sparked concerns that the Fed should have cut rates sooner. Tech stocks have also declined as investors worry about valuations and earnings. In volatile markets, it's important for investors to stay level-headed as they work towards their long-term goals. So stick to the plan that you and your advisor have agreed upon. Don't let these swings derail your goals. On to point number 3, recession fears. Firstly, it's important to remember how fickle the market expectations have been. This year began with investors believing that the Fed would need to cut rates several times due to an imminent recession. Expectations then shifted after a few hotter than expected inflation reports, with the investors believing that the Fed would not cut rates at all this year. Today, the market expects the Fed to cut in September and possibly at each subsequent meeting. These swings show how difficult it is to get monetary policy right, even as backseat drivers. These dynamics have shifted the Fed's focus to the labor market, with the Fed acknowledging that it is attentive to the risks of both sides of its dual mandate. The latest job report showed that the economy added 114,000 jobs in July, lower than the consensus estimate of 175,000. Unemployment, which was expected to remain at 4.1%, rose to 4.3%. While this is still relatively low compared to history, it is the highest rate of unemployment we've seen since the pandemic. One reason economists are concerned about this increase in the unemployment rate is an economic indicator known as the SOM rule, which is shown on your screen. The SOM rule, named after the former Fed economist, predicts the onset of recessions based on the trend of unemployment. The simple intuition is that a sudden jump in the unemployment rate is highly correlated with the economic downturns. In fact, the very definition of a recession partially depends on the state of the job market. The jobs report for July officially triggered the SOM rule, suggesting that the current unemployment rate is consistent with historical patterns of recessions. However, it's important to keep in mind that immigration and higher labor force participation, both very positive factors for the economy, were key drivers in rising unemployment. Additionally, SOM herself has stated that this is more of a historical regularity and not a hard and fast physical law. In other words, with unemployment still near historical lows, a rise in unemployment to 4.3% should be watched carefully, but does not necessarily mean a recession is imminent. Regardless, both sides of the Fed mandate maximum employment and stable prices now point strongly to a September rate cut. So where does the Fed stand today? Very few argue that the Fed has made the wrong moves per se. Just that they haven't timed it very well. While many may wish that the Fed had cut rates in the last meeting, it's likely that they will do so soon. Point number 4, the volatility index. Monday, August 5th, 2024, the CBOE Volatility Index, or the VIX, also known as Wall Street's fear gauge, experienced a significant surge, reaching its highest point since the pandemic market plunge in 2020. This surge, briefly exceeding 65, came after a period of relative stability for the VIX, which had frequently traded below its long-term average of 20. The VIX is calculated based on the market pricing for options on the S&P 500 and serves as an indicator of expected volatility over the subsequent 30 days. The rapid climb of the VIX was attributed to several factors, including traders seeking protection and shifting from short-term to long-term options during a period of heightened market uncertainty. The spread between the spot VIX and its second month futures contracts reached a deeply negative 30 points, indicating a surge in demand for immediate protection. This suggests that investors gripped by panic were willing to pay a premium for safeguards against the further losses in upcoming weeks. Despite the dramatic rise of the VIX, some interpreted it as a potential buying opportunity for stocks. Heightened fear reflected by the VIX could be a contrarian indicator, suggesting that stocks might be undervalued with the prospect of further short-term losses. However, we want to caution against viewing this as a definitive all clear signal, emphasizing that the VIX's movements should be interpreted with the broader market context. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment and hit that like button below. By hitting the like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you again for watching. We look forward to seeing you next week.